The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is titled Federal Responses to Recent Bank Failures. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I now recognize myself for 5 minutes to give an opening statement. Thank you to our witnesses for appearing before us today. Because of economic mismanagement under the Biden administration and failures of bank supervision, we now face increased odds of a recession. Following the Bipartisan CARES Act, a partisan, nearly $2 trillion Reckless American Rescue Plan Act was enacted by the president, which fueled runaway inflation. While the administration and Federal Reserve tried to convince the American people that inflation was transitory, it definitively was not. Inflation skyrocketed and persisted, and Americans were hammered by rising costs in grocery aisles and at the pump, and saw their wages rapidly eroding in real terms. Despite warnings from my Republican colleagues and myself, the Federal Reserve was late to the game in responding to inflation, and therefore had to raise interest rates at one of the fastest paces in modern history. The precipitous interest rate increases put heightened interest rate risks into the system, and regulators and supervisors at the Fed were again late to react. All of the context in which these bank failures occurred has to be looked at in the context of this historical set of facts. These risks were not attended to by the Fed or state regulators and supervisors, but were recognized by depositors. This led to bank runs and systemic stress. We now faced increasing odds of a credit crunch as banks of all sizes anticipate more onerous regulations and market scrutiny. If recent events are not dealt with productively, we also run a risk of ending up with a banking system with a small number of too-big-to-fail banks and a scattering of very small banks. Such a barbell banking system is not good for communities across the country. The Vice Chair for Supervision at the Federal Reserve has signaled his desire to go beyond reviewing supervisory failures that contributed to the recent bank runs. He continues to signal his desire to increase capital charges and impose more stringent regulations on already well-capitalized banks that are not to blame for recent stresses in the system. Following the failures of Silicon Valley Bank and Signature Bank that were caused by bank runs, key regulators decided to issue their own self-referential, self-assessment report on those failures to set a narrative. The chairman of the FDIC ordered a review of Signature Bank's failure, taking some blame for inadequate supervision, but the review mostly blamed the banks and internal FDIC vacancy issues. The full board of the FDIC did not adequately participate in the review. The FDIC also issued a term paper on deposit insurance and what it believes Congress should focus on before responding to multiple inquiries from this committee for information so Congress could arrive at our own conclusions. Vice Chair for Supervision Michael Barr led his own self-serving politicized review of the failure of Silicon Valley Bank and made regulatory recommendations. The full board of the Fed did not participate in the review. The review, by the way, said nothing about the monetary policy errors and the late to the game monetary normalization that contributed mightily to the problem. In the face of a need to inform Congress and respond to multiple requests from this committee for timely information, the Fed, the FDIC, decided to devote resources to a hasty, self-serving review of their own supervisory failures to set a narrative. To be clear, the board of the Federal Reserve System and the board of the FDIC should not view their recent narratives about failures of Silicon Valley Bank and Signature Bank as precedents for how Congress is informed in the future. Rather than being responsive to Congress so that we may consider potential legislative needs, federal agencies and officials have slow-walked us. Instead, they have spent their time writing their own narratives to cover their own mistakes and inject politicized calls for more regulation into the public sphere. That is simply unacceptable, and it clearly shows why we need to change emergency authorities for the Fed and the FDIC and Treasury to at least obtain accountability and transparency. We need to ensure that the full boards at the Fed and FDIC are adequately consulted in important decision-making, and that a single regulatory actor cannot act unilaterally to inject their political preferences into regulations. The bills noticed today get at the heart of increasing accountability and transparency at our federal financial regulators and emergency actions. The bills are not intended to be partisan, and their provisions would apply independent of what party is in power. They are simply about accountability to the American people and Congress of financial regulatory actors who take actions that affect trillions of dollars of resource flows. I look forward to discussing these issues today. The chair now recognizes the ranking member of the Subcommittee on Financial Institutions and Monetary Policy, the gentleman from Illinois, Dr. Foster, for 5 minutes for an opening statement.
Thank you, Mr. Chair, and I will not use my whole 5 minutes. This, I think, is a time where Congress is best served by, and the people are best served by listening instead of speaking. So, there are a couple of new factors and old factors that we see in this. The new factors were the internet-driven runs. That when we had our first emergency Zoom meeting with the FDIC, they would look kind of shell-shocked at the speed at which this run occurred. And that is a risk that everyone recognizes, and we're going to have to understand what kind of emergency liquidity support will be needed to defend against those. And for anyone providing that emergency liquidity, they will have to be able to tell at a glance that the entity they're providing that liquidity to will ultimately become solvent. And that is the difficulty with what we're going to be facing here. I see a value of both internal and external reviews, and I think they were valuable. The reports produced were, in fact, valuable as starting points to this. I also think we have much to learn with a comparison of the Credit Suisse failure and the recent effects. The bank failures that we've seen were banks of order 1% of U.S. GDP. They were not in and of themselves systemically crucial, and they wouldn't have brought down the economy if they by themselves had failed. In contrast, Credit Suisse was over 100% of Swiss GDP. It was truly too big to fail, and when it failed gracefully, without really a whiff of contagion and without leaving the Swiss taxpayer so far on the hook. And I think the difference there is contingent capital, that the contingent capital that was insisted upon by the Swiss banking regulators allowed a mechanism for when, as Credit Suisse failed, they allowed a mechanism to have a mandatory capital injection into the carcass of Credit Suisse that made it something worth buying. It took the value of Credit Suisse from roughly negative $14 billion to plus $3 billion and allowed a white knight to step in and take it over. So I think we should look hard at that as a model, and I know I share with Chair McHenry an enthusiasm for this general approach. Contingent capital is a market-based approach to have another set of eyes on the books of these banks and at their risk posture. Anyway, I'm eager to get on with this hearing, and with that, I'll yield back the rest of my time.
The gentleman yields back. And today we welcome the testimony of Ms. Margaret Tahyar. Ms. Tahyar is co-head of Davis Polk's Financial Institutions Group and a member of the FinTech practice. Her practice focuses on providing strategic bank and financial regulatory advice. In addition to her full-time practice, she teaches financial regulation as an adjunct lecturer in law at Harvard Law School. Mr. Jonathan Gould. Mr. Gould is a partner at Jones Day in Washington, D.C., where he provides bank and financial regulatory and strategic advice to financial services providers of all types. Previously, Mr. Gould served as the Senior Deputy Comptroller and Chief Counsel of the Office of the Comptroller of the Currency. Mr. Thomas Michaud. Mr. Michaud is President and CEO of Keefe, Bruyette & Woods, an investment bank specializing in the financial services sector, where he began his career in 1986. He was named Chief Executive Officer in October of 2011 and is responsible for directing all of the firm's business lines in both the United States and Europe. Finally, Professor Kathryn Judge. Ms. Judge is Harvey J. Goldschmid Professor of Law and Vice Dean for Intellectual Life at Columbia Law School. Ms. Judge currently serves as an editor of the Journal of Financial Regulation and a research member of the European Corporate Governance Institute. She previously served on the Financial Stability Task Force and the Financial Research Advisory Committee to the Office of Financial Regulation. We thank each of you for taking the time to be here. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, each of your written statements will be made part of the record. Ms. Tahyar, you are now recognized for 5 minutes for your oral remarks.
Thank you, Chairman, Ranking Member. A banking crisis is like a burning house. Just watching it, we know that mistakes were made, there are lessons to be learned, and changes are coming. Think of it as 3 stages. In the emergency stage, heroic firefighters rush into the flames to save the house and the people. Dedicated agency staff have been working around the clock. I've personally received a message at 2:45 a.m. asking if I'm available to talk right now. But reliance on firefighting is not a path to a better way. Once the flames die down, it is the what happened stage. Time to think about the very different people who were living in the house when it caught fire. That was management and the supervisors. What did they do or not do to let this fire happen? Final stage, we need to ask, did something in the construction of the house cause the fire? If the problem was the electricity, let's not focus on how people felt about the plumbing. For each stage, we need fact-based lessons learned and policy changes that encourage a strong, multi-tiered banking sector. So far, there are many suggestions based on political priors, which assume regulatory changes without proof of any links to the burning house. We also need much more transparency. It's not possible for the firefighters to be transparent in real time when the house is burning, but afterwards there needs to be a full accounting. Here's some preliminary thoughts. There should be independent reports by professional investigators. There are many good elements in the reports you have before you, but they are drastically incomplete. They are only a first step in any fact-based exercise. There should be a structurally independent investigation by trained professional investigators done on a bipartisan basis. There's a deep red flag in the reports that Congress should not ignore. They point to severe resource challenges for examiners, lacunae in the skill sets, weakness in the job candidates, as well as heightened turnover. It's concerning that new examiners resign before completing their training, that fully funded posts cannot be filled, and there are press reports of culture problems and low morale causing experienced examiners to leave. The consequence is that at critical times, examiners were slow to react, did not have internal deadlines, and became distracted by process and consensus. The many media leaks from the supervisors complaining about the culture or attempting to absolve themselves are also clues that something is amiss. The Barr report hints at confusion around internal governance, escalation, roles and responsibilities, deadlines, and accountability. It raises the question whether the supervisors were well managed. It is deeply unfair to blame overworked line examiners not given fully updated training and suffering from poor direction and management. These red flags might be a more plausible cause, at least in part, for the supervisory failures, rather than an unexplained shift in tone from the previous leadership, the tailoring, or the guidance on guidance. All of the agencies need to engage in a holistic review of how the supervisory staff is hired, trained, and managed. Virtually all of banking supervision takes place in secret. The lack of transparency sits uncomfortably with the securities laws and with accountability to Congress and the public. It's impossible for Congress, academics, and the public to judge the effectiveness of the regulatory framework, supervision, or emergency actions when what the public sees is only a very small tip of a very large iceberg. We really need to ask, who is watching the watchman? Finally, let's be careful out there. There's one big thing where congressional action, as opposed to oversight, is necessary: a hard look at reforms to the deposit insurance program. We have never seen a deposit run of such scale and speed happening overnight and on a weekend. In a world with social media, mobile banking, and when many companies and consumers are multi-banked, uninsured deposits can flee with a click. And the multi-banking is a point that hasn't gotten a lot of attention. If you're going to flee with a click, you got to have 2 bank accounts. And if you think about the difference, there was a reference to a barbell banking system, which we don't want. You know, many of the customers of regional banks are sticky. They're not necessarily multi-banked. That's something to look into. Anyway, with instant payments, open banking, data portability, or a central bank digital currency, is it going to make it worse or better? Absent deposit insurance reform and solving the red flags, the regulatory changes being suggested will be window dressing. It matters because an impact on banking is an impact on the economy and credit, already fragile. For those of you who remember Hill Street Blues, let's be careful out there. Thank you.
Thank you for your testimony. Mr. Gould, you are now recognized for 5 minutes.
Chairman Barr, Ranking Member Foster, and members of the subcommittee. Thank you for the opportunity to discuss the federal responses to recent bank failures. My testimony will focus on the recently issued reports from the Fed and the FDIC on their supervision on Silicon Valley Bank and Signature Bank. My testimony is my own. I'm speaking today solely in my personal capacity. I am not speaking on behalf of any clients or my law firm. According to the Fed's Office of Inspector General, and I quote, examiners identified key safety and soundness risks, but did not take sufficient supervisory action in a timely manner to compel the boards of directors and management to mitigate those risks. In many instances, examiners eventually concluded that a supervisory action was necessary, but that conclusion came too late to reverse the bank's deteriorating condition. This statement might well summarize the reports from the Fed and FDIC, but it was actually issued in 2011 in connection with the OIG's review of Fed supervision of the 35 state member banks that failed in the aftermath of the 2008 financial crisis. In the years following this assessment, Congress has enacted major banking reforms, and the banking agencies have promulgated a host of new regulations and revised their supervisory approaches. And yet we seem to have made little progress in improving supervisory outcomes without recourse to extraordinary interventions like guaranteeing uninsured deposits. Agency self-reflection is appropriate, but supervisory transparency and congressional accountability are critical. The Fed and FDIC reports offer a starting point for further fundamental review by Congress. Supervision and regulation are complementary, but worth distinguishing. Regulation is broadly applicable and implements statutory imperatives. Supervision is the practical art of applying that regulatory framework to individual banks through the exercise of examiner judgment. In the case of SVB, the Fed acknowledges that its supervision failed to identify, much less address, some of the most basic safety and soundness risks applicable to a bank. It is particularly hard to explain the Fed's failure to supervise for interest rate risk when it created that risk through its own monetary policy actions. Neither report explains the many failures of supervision, and significant portions of the reports are distraction. An independent review and disclosure of internal agency communications about SVB and signature supervision would seem an obvious next step in any credible investigation. Both reports raise questions about the adequacy and allocation of resources at these agencies, but the reports give us little information as to how the agencies prioritize their resources. Congress should request and review budgetary detail and supervisory staffing models, including those for the San Francisco Fed, to determine whether the agencies are giving short shrift to their supervisory functions or if it disagrees with their priorities. The Fed report does address changes in regulation it made following the Economic Growth Act. Others have addressed the lack of causal connection between that law and the bank failures. I will merely add that 1, the Federal Reserve did not enforce regulations that did apply to SVB. 2, the proliferation of regulations since the 2008 crisis may have reduced risk management and supervision to mere compliance exercises, damaging both in the process, and 3, over-reliance on preferred regulatory tools may have blinded supervisors to risks that do not appear when viewed through that tool's particular lens. The Fed has a unique governance and structure that differ from other bank supervisors. Congress should consider whether and to what extent the Fed's structure and governance is a contributing factor to its supervisory failures. A clear presentation from the Fed of roles and responsibilities within the system and between the board and reserve banks is a prerequisite for basic accountability. The Fed report identifies some potential conflicts of interest between the reserve banks and the board. An even greater concern is the inherent conflict of interest between the Fed's monetary policy and bank supervision functions. The Fed's rapid interest rate hikes are a source of systemic risk to the banks it supervises and were a cause of SVB's failure. Congress should explore how the Fed's monetary policy decisions, including its macroeconomic outlook, affect its supervisory strategies in general and its supervision of SVB in particular. The business of banking is built on trust and confidence, but that trust and confidence is currently in doubt. Competent bank supervision is a prerequisite to restoring it. Transparency into the supervisory strategies and priorities of the Fed and FDIC, particularly as they were applied to these failed banks, is a critical first step in understanding what went wrong. Given past failures at self-reform, Congress can and should exercise its full oversight authorities to ensure a different outcome this time. Thank you again for the opportunity to testify. I look forward to your questions.
Thank you, Mr. Gould. And now, Mr. Michaud, you are now recognized for 5 minutes.
Good afternoon, Chairman and Ranking Member Foster. Thank you for having me with your subcommittee today, and thank you to all the rest of the members. By way of background, my name is Tom Michaud, and I'm president and CEO of Keefe, Bruyette & Woods, a Stiefel company. I've been with KBW for 36 years, and I focused my career on being part of a team that delivers high-quality banking and financial services research advice, particularly to mid-sized and regional banks. We also produce the Keefe Bank Index, the Keefe Regional Bank Index, both of which are standards upon which bank performance is rated. The current banking crisis has been driven by fear. Although each bank crisis is unique, they all have one thing in common. Depositors lose confidence in that their money is safe, and they seek a safer haven. That is why the FDIC was created 90 years ago, and no insured deposit has ever lost value since. FDIC insurance has allowed the U.S. to have a diverse banking system of all sizes. Global banks, regional banks, mid-sized banks, and community banks. The recent bank failures have illustrated two developments since Congress last modified deposit insurance 13 years ago. Money now moves faster than ever before. The speed of the run at Silicon Valley and Signature Bank was staggering. Number two, the market has embraced that the biggest banks are likely too big to fail, and that there's an implicit government guarantee that stands behind them. Those are the two key factors that have changed since Congress last changed the rules. Left unaddressed, I believe that there will be strong forces that will restructure the banking industry, and current Fed data suggests that it's underway right now. Having banks of all sizes is critical to the success of our economy. America's largest banks are global leaders and stand out amongst their international peers. While the biggest banks have most of the deposits, they don't make most of the small business loans in America. For America's economy to prosper and benefit all Americans, not just in large financial centers, regional banks are essential. That was demonstrated when they provided 60% of the PPP loans during the recent pandemic. But there is an opportunity to level the playing field since the deposit limits were last changed. I believe that the big banks can continue to operate the way they do, but that the mid and smaller banks need more deposit insurance to neutralize that too big to fail guarantee. The modifications I propose are on the belief that deposit insurance will continue to be an industry expense and in no way encompass taxpayer support. Therefore, I believe that Congress should address the problem with three actions. Number one, raise the DIF limits for operating accounts so that small business and nonprofits can keep their funds in a local bank and not worry. Number two, allow banks to buy additional insurance directly from the DIF. Number three, further tailor premiums for the systemic banks to account for the too big to fail implicit guarantee. I would also encourage that number one, healthy bank M&A be allowed and accepted so that banks can seek the same scale benefits that their larger competitors have. Also, we need healthy bank M&A so that healthy banks can acquire underperforming banks and save an ultimate loss possibly to the deposit insurance fund. Number two, regulators should modify held-to-maturity accounting treatment as well as modify treatment of OCI into other regulatory ratios. And then number three, as a comment that was made recently during the introduction, a review should be done to ensure that government agencies have the proper systems in place to support the financial system as real-time payments becomes a reality, especially with the rollout of FedNow in July. I believe that these steps would be sufficient in addressing the current instability in banking. The stocks, again, were weak, very weak today. I also believe that their lack of complexity reduces the risk of the lack of complexity of these changes reduces the risk of unintended consequences, and that this approach avoids the possibility of additional regulations that could prove to be counterproductive. Thank you for the opportunity to be in front of you today, and I look forward to hearing your questions.
Thank you, Mr. Michaud. Now, Professor Judge, you're recognized for 5 minutes.
Thank you, Chairman Barr, Ranking Member Foster, and members of the subcommittee. It is a pleasure to be here today, and I appreciate the opportunity to discuss the recent bank failures and the lessons that we can learn from those failures. I want to spend my time just setting the stage with two broad points that hopefully cut across the range of different issues at stake in today's deliberations. And I also want to spend a few moments just building on and responding to some of the comments from my fellow witnesses. First, the recent bank failures reveal fundamental shortcomings in the regulation and supervision of large regional banks. Since the beginning of March, 4 regional banks have failed. 3 of those banks failed in ways that impose significant costs on the Deposit Insurance Fund. The FDIC currently estimates that the Deposit Insurance Fund will lose $20 billion in connection with the failure of SVB. It will lose $2.5 billion in connection with the failure of Signature Bank, and it will lose $13 billion in connection with the failure of First Republic. Moreover, 2 of those banks failed in ways that pose such a risk to systemic stability that all of the regulators involved voted to approve the use of the systemic risk exception to the requirement that the FDIC otherwise resolve the bank in the way that imposes the least cost on the Deposit Insurance Fund. This was not a political decision. Both the Board of Governors of the Federal Reserve, the FDIC Board, are bipartisan bodies, and there was unanimity among these bodies that this was the correct course of action under the circumstances. The imposition of such significant costs to the Deposit Insurance Fund and the existence of such a widely recognized threat to the stability of the financial system clearly demonstrate that the regulations currently governing large regional banks are not adequate. More needs to be done. Second, this episode is a powerful reminder of the ways that the digitization of finance has and will continue to change the nature of banking, the pressures that banks face, and the structure of the financial system. It is a critical time for regulators and for Congress to stay on top of recent developments and to look broadly to identify emerging risks. Although it might not seem directly relevant to today's hearing, the new guidance proposed by FSOC for designating non-bank financial institutions as systemically significant and its proposed analytical framework for systemic risk are prime examples of the way regulators should be using the available tools to address emerging risks before they pose a threat to the financial system. More work could also be done to consider how best to protect the financial intermediaries and financial infrastructure that provide critical credit and financial services needed to promote a healthy and balanced economy. This could include more efforts to promote the vitality of community financial institutions, including community banks, MDIs, CDFIs, and helping to ensure that they remain focused on serving the small businesses and the wide array of families and individuals that need access to the services that they can provide. Finally, I want to comment quickly that I agree with my fellow witnesses on the importance of supervision in the coming era. Again, digitization means that a lot of things are moving, and they are moving quickly. It is often during periods of higher inflation and higher interest rates that we end up with more disruptive changes to the structure of the financial system. So it has never been so critical to have really qualified supervisors on the ground who are willing to ask the hard questions and are willing to think creatively about what are the tail risks, what are the low probability events that could result in things happening that we haven't seen in the past, but could be incredibly disruptive to the safety and soundness of an individual bank or to the health of the broader financial system. And I would encourage you in trying to think about how we create the right culture and environment to attract the type of supervisors that we're going to need going forward, that you take time to consider what is the type of environment that is going to allow those supervisors to ask hard questions and to respond in a way that is appropriately responsive and at times when needed aggressive in making sure that banks are attuned to the ways their actions could undermine their own safety and soundness, and even more disconcertingly, potentially undermine the health of the broader financial system. Thank you again for the opportunity to be here, and I look forward to your questions.
Thank you, all witnesses, for your testimony. And the chair now recognizes himself for 5 minutes for questioning. Let me start with Ms. Tahyar. As I mentioned in my opening statement, the Vice Chair for Supervision at the Fed and the Chairman of the FDIC led self-assessments, self-referential reviews. In your view, do these reports provide the impartial accountability for the Fed and the FDIC to Congress?
No.
And what are the consequences of, and I also alluded to the fact that we've made multiple requests for more information, supervisory information, information about the weekend of March 10th, about the events leading up to the decisions to seize the banks, FSOX meetings. We have nothing from the regulators in terms of visibility into those deliberations. What are the consequences of having opaque bank regulators that block the information flow to Congress?
Well, I guess I'd start by having a little bit of sympathy for the firefighters who have been working 24/7 virtually, which is why I'm in 3 stages. But I think over time, Congress, both sides of the aisle, needs to get a lot more information and a lot more transparency. And the consequences are the consequences that we have seen here, which is we've had a failure of supervision, a failure of management, and a banking panic. And there will always be banking panics. We can't prevent them, but we can mitigate them.
Mr. Gould, let me talk about that supervision piece. In the Fed's review that it just recently published, it talks about the fact, and I'm drawing on memory here, but I believe that Silicon Valley Bank surpassed the $100 billion asset mark sometime in early 2021. The failure, of course, was March of 2023. There was some effort to put a new supervisory team in place, but am I correct in saying that the bank was subject to enhanced prudential standards all the way back to February, March of 2021?
Yes, that's correct. The bank was subject to certain enhanced prudential standards.
So it's not as if, and this is, by the way, Dodd-Frank as amended by the Bipartisan Regulatory Relief Act. So it's not as if Silicon Valley Bank wasn't subject to enhanced standards under those regulatory regimes. Am I correct about that?
That's correct. And some of the standards to which they were subject, such as the internal liquidity stress testing requirement, the Federal Reserve was not even actually enforcing.
Yeah, so I mean, this excuse for supervisors that somehow they were psychologically impacted by the regulatory relief law doesn't really hold water when you consider that they had a charge under existing regulation, existing laws, to apply those enhanced supervisory standards to this institution for well over a year before it failed.
They did, and beyond the regulatory framework to which they were subject, the failings were so basic, so fundamental to kind of risk management 101 as to be glaringly obvious under any regulatory framework.
Yeah, and let me just say, I mean, interest rate risk is something that bank examiners have looked at long before Dodd-Frank was ever enacted, right? You don't need Dodd-Frank to supervise interest rate risk.
That's fundamental to the business of banking. That is how banks make money.
Yeah, so this attempt to blame regulatory tailoring or even an insufficiently robust Dodd-Frank regime is really missing the point here. This was a classic supervisory failure. Interest rate risk is the business of banking, and the supervision was a failure. Mr. Gould, if Vice Chair Barr used Silicon Valley Bank and Signature Bank failures as leverage to impose higher capital charges on banks, even though SVB and Signature were capitalized before the bank runs they experienced, would that be good for the economy and Americans who rely on bank credit?
Look, I think others are probably better equipped to answer that question, but I don't think anyone has a monopoly on common sense, so I would merely add that there are clear trade-offs when you raise capital in terms of reduced availability of credit.
Well, Mr. Michaud, for the small regionals, the mid-sized banks, if we were to eliminate regulatory tailoring, and to the extent there's some stresses related to deposit migration out of these mid-sized banks, should we be imposing a one-size-fits-all regulatory capital and liquidity requirements on those smaller banks right now?
I think it would permanently change the face of the dynamics of banking forever if that happened. I think that you would see the mid-sized banks be absorbed into the bigger banks, and you'd have that tremendous barbelling that we talked about, where there'd be banks who only had clients that were smaller than $250,000, and then all the other clients would end up in the bigger banks.
My time has expired. I wanted to get to deposit insurance. I'm sure my colleagues will. But at this time, I will now recognize the ranking member for 5 minutes.
Thank you. Mr. Michaud, you brought up something that's been brought up by many people, which is the idea of fully insuring transaction accounts, operating accounts. Could you speak on, what are the pros and cons of that? Why isn't it a good idea at this point?
So let me give you an illustration, because many of us have been talking about this barbelling of the industry. So I'm just going to say, if, for instance, assume you're a CFO or a treasurer, an employee or a volunteer of a nonprofit in one of your communities, and you have over $250,000 in your operating account to run your nonprofit. The way things stand now, with the current limits, you have to do your own credit analysis of your bank or go towards moving your money to a too-big-to-fail bank because you need the
Correct,
safe harbor.
this is, I think, well understood by many, but not all potential customers.
But my view is that you need that support for you. I don't know if it needs to be unlimited. I do think it needs to be raised considerably, but I think it needs to be targeted because I think it's those small businesses that will choose to be in a too-big-to-fail bank, regardless of the price or the service or the relationship they have with their smaller bank, and that trend will happen over time if deposit insurance isn't changed, in my opinion.
Professor Judge, do you have any?
I would agree that when it comes to the small businesses, it's important that they have peace of mind to know that their transaction accounts, at least, are safe. And I think the FDIC did a nice job laying out the different options and showing how segmentation, a way of just saying that there's something different for individual accounts and what the appropriate cap is relative to the small and mid-sized businesses that might need meaningfully more deposit insurance in order to make things like payroll. So I do think trying to think about how we responsibly institute a system of segmentation could be incredibly helpful in promoting the health of community and other small banks, and also helping to promote the stability of the clients that they serve.
Mr. Michaud, you also mentioned using differential FDIC insurance premiums as a way to sort of level out the barbell. This strikes me as having a lot of elements of sort of a big banks tax and a redistribution of wealth. If they're not based on actuarial risks, I was just wondering how you think of that, which I'm not necessarily opposed to, but we have to sort of treat it for what it is.
There is an implicit guarantee in this too-big-to-fail position that these banks are in. So they get the benefit of paying less for deposits because of the trade-off for safety. So they're actually getting value in that aspect for being too big to fail. And the question is, can we have them pay more for deposit insurance for some of that value they're getting for being too big to fail? That's the thinking.
Yeah, well, one of the reasons that I think Chair McHenry and I are fans of contingent capital as a mechanism for making the big banks pay for the tail risk of their continued existence in troubled times. Are there any lessons to be learned about the mark-to-market of losses due to interest rate shifts? Because that's something that we struggled with during Dodd-Frank time with mark-to-market of mortgage-backed security losses. Whether you should immediately recognize those or allow the fiction that these will be, carried to maturity, which may or may not turn out being true. Are there lessons learned there from any of the witnesses? Have any observations?
I think there are, and actually in my proposal to you all, I did say that there should be some adjustments, and that it could be, you can put in place targets where there could be limits to a degree of how those ratios come to bear, but the market was very focused on these mark-to-market losses at Silicon Valley Bank, for example, even though it wasn't necessarily counted in certain regulatory ratios, and I think there is an opportunity to amend some of that approach that could build a safer and sounder system. Also remember, too, we've had a 5 basis point move in 14 months, which is extraordinary, but that is what the rules should be built for.
Yeah. Well, it was clear to all market participants that there was an interest rate shift coming, and that was telegraphed in advance, and that it would be big. And many banks hedged it appropriately, and some decided that they wanted to be more profitable this quarter and not pay for the hedge. And so I, personally sort of limited sympathy for, I appreciate the moral hazard effect of this. A lot of the customers that went to Silicon Valley Bank went there because they were paying higher interest rates than their competitors, and part of that was that they had lots of uninsured deposits. And so we have to think this through carefully so that we don't inadvertently just start subsidizing the tail risk and load those costs on smaller banks. My time is now up, and yield back.
The gentleman's time has expired. The gentleman from Florida, Mr. Posey, is now recognized for 5 minutes.
Thank you very much, Mr. Chairman. As I recall, this committee was told there wouldn't be any bank failures like this if we created a CFPB. I'm kind of shocked we're here if the CFPB was doing its job. First, Mrs. Tahyar, rates go up, capital values go down. Barron estimated that the undeclared loss on Silicon Valley Bank's bonds due to the rapid run-up in interest rates starting in March 2022 would have wiped out nearly all of the bank's $16 billion equity capital base at year-end 2022. Would it be fair to say that capital was not the real problem here?
It was not. Capital is a lagging indicator, and the banks that failed were well capitalized upon failure. We saw the same thing with adequate capitalization during the financial crisis.
Very good. Thank you. Mr. Gould, is there any reasonable capital standard or level that would have protected against the interest risk of Silicon Valley Bank's asset base in the period after Fed rate hikes began in March 2022?
No, it would not.
Thank you. Mr. Michaud, wasn't the rapid and massive increase that the Fed began in March 2022 to curtail our 40-year record inflation a contributing factor in Silicon Valley Bank's lack of liquidity, given that its asset base was heavily invested in fixed-rate mortgage-backed securities?
That move was significant, correct.
Thank you. Professor Judge, to what extent did the Federal Open Market Committee anticipate the kinds of interest rate impacts we saw with Silicon Valley and prepare an alert or strategy for regulators to prepare for such impacts?
The overarching aim of the FOMC is to fulfill a dual mandate focusing on both employment and price stability in a period where inflation was rising rapidly, not just in the United States, but in countries around the world. Their primary focus for the health of the economy, I believe, was probably on trying to make sure that we managed to promote price stability, get that inflation under control. And precisely because of these environments, it's never been more important to have sufficiently robust regulatory structures in place and to make sure going forward that we have supervisory structures that are responsive to a rapidly changing environment and where there's not procedural hurdles or perceptions of procedural hurdles that allow people to respond quickly and appropriately in the face of such a rapidly changing environment.
My questions are answered, Mr. Chairman. I yield back. Thank you.
Gentleman yields back. The gentlewoman from New York, Ms. Velasquez, is now recognized.
Thank you, Mr. Chairman. Professor Judge, the rescue of depositors at Silicon Valley Bank and the invocation of systemic risk exception by federal regulators demonstrate that regulators think regional banks can pose a systemic risk to the system. Do you think that these banks should face the same rules as the gypsy banks?
There continues to be some difference between large regional banks and the globally systemically significant financial institutions. And I think all of the proposals on the table recognize some difference and the appropriate of some tailoring. The question is the extent of the magnitude of what those differences should look like. And one of the things that we've learned over the course of this episode is regardless of what might have seemed reasonable at earlier points in time, these banks are so systemic that everybody involved who was operating in real time felt like they pose a meaningful threat to the stability of the financial system. The risk at Signature looks somewhat different than the risk at Silicon Valley Bank. So this was not just at one single bank, but a whole variety of different bank models that were under strain. And what we've further learned is that the resolution of these banks is far from easy to do. Even in respect of First Republic, where we did not actually have to invoke the systemic risk exception, we saw a $13 billion hit to the Deposit Insurance Fund, which suggests we have a long way to go to make sure that they're regulated in a manner commensurate with the risk they pose.
Thank you. And you note in your testimony that bank leaders can seek to game the rules and take on additional risk in order to seek higher profits. I recently wrote a letter with Senator Van Hollen to federal regulators encouraging them to finalize their rulemaking under Section 956 of Dodd-Frank which is supposed to prohibit incentive-based compensation structures that encourage excessive risk-taking. Wouldn't you agree that this is well past time for regulators to finalize this important rule?
It's clearly past time for that rule to be finalized. I think the letter is exactly what we need to create the pressure to try to make sure that regulators are fully using the suite of tools currently available to them that Congress has given them to address the incentive issues that continue to arise and that encourage bank management at times to take risks from which they could profit, but where others bear the loss.
Thank you. And you also note that the tools regulators have to penalize and remove bank officers and hold them accountable remain inadequate. What additional measures should we consider to hold bad actors accountable?
A more robust set of clawback tools would also be appropriate, as the situation well demonstrates. Clawback tools are a mechanism of saying when an executive has received compensation because they appeared to be earning it, but where we know with the benefit of hindsight that they were actually making decisions that undermined the safety and soundness of the institution that they were overseeing and imposing costs that ultimately hit the deposit insurance fund, we want to make sure the bank executives, first of all, don't have the incentive to take the types of risks that would undermine the health of their institutions because they know they're going to have to pay the money back, and where there's a greater sense of fairness that they are not profiting at the expense of others.
Thank you. And in your testimony, you state, in 2019, the Federal Reserve made a choice to implement the Economic Growth, Regulatory Relief, and Consumer Protection Act in a manner that was meaningfully more deregulatory than the revised statutory scheme required. Can you further explain this statement, and how do you think Congress, not regulators, can address this issue?
2 points there. The first thing to note is that Congress appropriately at the time, potentially appropriately at the time, gave the Fed discretion over what to do with banks of certain thresholds, with the idea that the Fed was closer to the ground, so they might have better information over how risky banks, for example, in the $100 to $250 billion range actually were, and the appropriate suite of enhanced prudential requirements to apply in light of that. And we saw that they did not actually use that discretion in a manner that was commensurate with the risk we now know that those banks were assuming. So for me, that suggests going forward, ramping back on that discretion, understanding that there might be a tendency towards excessive deregulation because the costs are only felt in the future, and really trying to potentially hardwire standards that are more commensurate with what we've learned recently is the nature of the threat that these banks have the potential to pose.
In conclusion, Congress needs to act. Thank you. I yield back.
Gentlelady yields back. The gentleman from Missouri, Mr. Luetkemeyer, is now recognized.
Thank you, Mr. Chairman, and thank our witnesses for being here today. I want to start out by going to Ms. Tahyar. You mentioned in your initial remarks that the social media phenomenon of being able to get out there and get a message out there that caused, I think in somebody's words here, banking panic, is to me very concerning, because I think, not necessarily from a bank-by-bank basis, but from a systemic situation. This is where I want to go with my questions here, because the banks, individual banks, are going to be, some are going to be well-run, some not well-run, and this situation we have here, I think we've got a lack of regulatory oversight and bank management on the 2 or 3 banks we're talking about. But the system is what I'm concerned about. The overall system can be played with. I sit on the China Select Committee as well. And it scares the dickens out of me when I can see that we are playing games with our own financial system now by the tweets that are going on and the social media that's going on. And I just know the Chinese are sitting there watching what's going on, saying, we've got another tool in our toolbox to play around with the United States economy, their banking system, and we're doing nothing about it. And it's very concerning to me, because from the system standpoint, we've got to be thinking in terms of what the bad guys are going to be doing to us, and to be able to prevent that from happening, or put a tool in a toolbox for the regulators to be able to manage the crisis. So, Mr. Gould, I think you said that the system is built on trust and confidence, and Mr. Michaud, driven by fear. People lose time or lose confidence in the system, things happen. And so my concern is also that we have real-time payments coming around the corner here shortly. And so We saw $42 billion run off the books of Silicon Valley in less than 48 hours. In real-time payments, it'll take 48 minutes to do $42 billion if we're not careful and we don't understand how the system works and put some things in place to stop it. So I've got a couple of ideas. I want to run them by you this afternoon here. One is to put in place the ability for the FDIC to put, and they did this back in 2010, to put in place a 60-day ability to protect transactional accounts and deposits at these institutions across the country. Right now, they can do it on a bank-by-bank basis, but if the risk is systemic enough that we could have the whole system be under attack, I think it'd be worthwhile to be able to have them go at least on a 60-day basis with just transactional accounts. What do you think about that, Ms. Tahyar?
Thank you very much for those thoughts. I agree with all of them, and you terrify me, and I think we should all be terrified. Social media and bad state actors in this panic is a new thing, and we have to grapple with it. My own view is that providing the FDIC the power with the 3 keys of the systemic risk exception to temporarily guarantee deposits up to whatever level the FDIC chooses is an important tool. Congress limited it in Dodd-Frank. That was a different time. House was burning for a different reason. Feels to me like what Congress said is, thank you very much for the firefighting, now we're going to defund the firehouse. And so I hope that Congress really thinks about putting that back in place.
Mr. Michaud?
I would agree. I think orderliness is important, and I think that tool could create a more orderly moment to address the bigger picture and take important corrections.
I think it puts some calm in the system, gives you 60 days to settle down. You figure out if you really have a threat or not.
100%.
If you do have a threat, then you can come to Congress and do something, but if you don't have a threat, take it off and off you go.
What you'll see is there's a lot of churn in the equity and fixed income markets and bank securities, which is a reinforcement for concern.
Mr. Gould, what do you think of that?
I think you should just make sure you understand the costs and the incentives that such a mechanism would set going forward. And I think, as a prerequisite to informing yourselves as to whether that's appropriate, I think you need to get more transparency from the Fed and the FDIC as to actually what happened during that 3-day time period, which I think as yet we still haven't seen. So I think, in order for you all to make an informed decision, I think you first and foremost need to get more information from them.
Very good. One of the things that we had SEC Chairman Gensler here a couple weeks ago, and we asked him about whether he had the authority to stop short selling across an industry-wide basis. And in fact, today in the Wall Street, there's another article with regards to short selling banks. Ms. Tahyar, do you think that he has the authority right now to do across the board? He kind of waffled on that.
Well, the chair of the SEC did it in September 2008, and nobody questioned the authority at that time.
Okay.
So he clearly has it.
Okay, thank you very much. I yield back.
Thank you. The gentleman's time has expired. The gentleman from California, Mr. Sherman, is recognized for 5 minutes.
Thank you. I don't think we can tell the bank regulators that it's not their fault because we had different monetary policies or fiscal policies over the last few years. I'm very old. Got some other old people here. We and some young people too. Some much younger than myself. But us old people remember that we've had 0% interest rates, we've had 16% interest rates. Interest rates go up, interest rates go down. We've had fiscal budgetary surpluses under Clinton. We had enormous fiscal budgetary deficits under Trump and others. Fiscal policy goes up, fiscal policy goes down. We need a banking system where banks can survive not only the existing fiscal and monetary policy, but changes as they may occur. Mr. Gould, you're wise to have pointed out the governance structure of the Fed and the whole system. First, we have forum shopping. We don't allow that in almost, you can't say, well, I don't like this IRS, I want to go to the other IRS to audit my returns. And we have a governance structure in which the banks elect the people on their regional boards, who are then in charge of auditing them. And if we had a system where only billionaires subject to audit would determine who is running the IRS, we'd have a very different tax system. Mr. Michaud, you bring up an interesting proposal on FDIC insurance. We kind of have two proposals. One is for expanding coverage of operating accounts. When you say operating account, are you limiting that to non-interest-bearing checking accounts?
Pretty much operating transaction accounts as
But I
defined.
mean, how would you define that?
Typically, I think it would be the operating accounts that businesses and nonprofits and others use for their daily business, and it could be.
It's very
defined.
hard in running, determining, well, am I a business? Am I just an individual? So
The
investment-
FDIC in their report,
they have a
they
definition.
laid it out and gave you the bookends for what you could use for a definition.
Okay, I would think that we would want to limit that to non or pretty much low interest rate accounts. If people have more than $250,000 to invest to earn interest, that's a different circumstance. The other policy, though, idea is having, on occasion, temporary system-wide unlimited insurance. And I'm concerned that if we did that, people would pull their money out during that temporary period. Or we make it permanent and just have total FDIC insurance, which comes very close to a bailout. Is there, Mr. Michaud and Mr. Gould, do you see unlimited insurance of all FDIC accounts, either temporary or permanent, as a way to go?
I've been a fan of the targeted approach, which is you could pick certain types of accounts, but not necessarily insuring all accounts.
I want to put up this chart here. What we see here is this huge, unprecedented, unrealized losses on marketable securities. We saw our 2018 law allow the Fed to not be tough on these issues with regard to medium-sized banks. Ms. Judge or Mr. Gould, is it standard practice as a part of regulating a bank to calculate how much the bank has lost because of interest rate risk? You can do that obviously on marketable securities, but on portfolio loans, you say, that's a 5-year loan. At the time the loan was extended, rates were at 2% for 5-year loans. Now they're at 6% for 5-year loans. It's pretty easy to calculate back and determine how much the bank has lost. And then compare those losses, unrealized losses on loans and bonds, to the bank's capital. Is that a standard part of regulating banks?
Clearly, it is for the largest banks.
But we could
And
do
as
it
a-
with all the banks, couldn't we?
And as a regulatory matter going forward, we should be clear.
So you're
to
saying
include
that
these losses.
just preparing a schedule showing losses due to interest rate risk is something we didn't bother to do on medium-sized banks, not because it's hard, but because we didn't want to know the answer?
I don't know what they were looking at the time. I believe, if I'm going to provide any defense, that there was an expectation that you would have some type of offset. The regional banks push back against this,
what you do
arguing
is you
for
blind
gains.
yourself to how much money you've lost by believing your customers are willing to subsidize you by leaving the money in.
Which is
And if you believe that, you'd probably run up a $35 billion cost to our system.
Which is exactly why going forward, regardless of what was true in the past, going forward, depositors have woken up, and it's very clear we need
The
to be more
gentleman's time has
aggressive.
expired. The gentleman from Texas, Mr. Williams, is now recognized.
Thank you, Mr. Chairman. Americans, and thank you all for being here today. Americans are struggling under the weight of crippling inflation, and families are being forced to decide whether to put food on the tables or pay the rent. The Biden administration's massive spending spree of executive orders has fueled this crisis. Democrats' partisan American Rescue Plan injected $1.9 trillion into the economy, ignoring the warnings that this plan would cause skyrocketing inflation. And as a result, the Federal Reserve has continued to increase interest rates to their highest levels since 2007. Now, Mr. Gould, in your testimony, you stated that the Federal Reserve's rapid interest rate hikes are a source of systematic risk to the banks they supervise and were a cause of the Silicon Valley's bank failure. So can you elaborate on how interest rate hikes cause these bank failures, and how do you think the Fed failed to supervise the banks they oversee for this risk?
Yes, sir. the rising interest rate risk caused the bond portfolio, the investment portfolio of banks like SVB to decrease, and they accrued all these unrealized losses, which investors began to pick up on and see that there were significant unrealized losses on the bank's asset side of their balance sheet. This is a phenomenon that was well understood, well known. In fact, as recently as a month before Silicon Valley Bank's failure, Fed staff briefed the board on the impact of rising interest rate risks on banks, on their balance sheets and their investment portfolios. And literally, the case study was Silicon Valley Bank. That was a month before it failed.
Wow. Next, I want to discuss the Federal Reserve's report that reviewed the supervision of Silicon Valley Bank. Key findings determined that Silicon Valley Bank's board of directors, you just touched on that, and management failed to manage their risks. On top of that, the key findings go on to say that Fed supervisors did not appreciate the extent of the bank's vulnerabilities. In 2022 alone, federal supervisors issued 3 findings on the SFB's ineffective board oversight, their weakness in risk management, and the bank's flaws with their internal audit function. So it should raise major concerns to the Federal Reserve, who is tasked with regulating and overseeing banks, knew about Silicon Valley Bank's risky practice and identified vulnerabilities for more than a year, but failed to take corrective actions to ensure SVB fix those problems. So despite there being 2 main causes of the SVB failure, the Fed report stated, this experience has emphasized why strong bank capital matters, and goes on to discuss the need for stronger bank capital. So again, Mr. Gould, in your opinion, would you think about requiring more regulatory capital above the current levels? Would that have prevented the failures of Silicon Valley Bank and Signature Bank, which were well-capitalized banks? Would heightened capital levels have prevented SVB mismanagement or the Fed's supervisory failures?
So even under higher capital standards, it would seem that, according to the Fed report, that the Silicon Valley Bank would have remained adequately capitalized. I think there are questions around whether or not and how to treat unrealized losses in certain investment portfolios, and whether or not that volatility should flow through to regulatory capital. I think those are questions that should be examined. But at least as I understand it, the regulatory capital levels of SVB, even had they been higher, they would have still been met.
Okay. As a result of the failures of banks in California and New York, taxpayers in Texas, is where I'm from, and across the United States could be left footing the bill for these banks' mistakes and mismanagement. And now Texas banks face possible FDIC insurance assessments for something they had no part in creating. The FDIC has an obligation to get the best price in failed bank auctions and avoid having to use taxpayer funds to bail out these banks. And during the auctions, SVB and Signature, the FDIC did not move fast enough to find a viable buyer, letting multiple days pass while there were reports of several offerings to these banks before a bid was approved. So finally, Mr. Gould, again, could taxpayers have been spared from paying for the failures of these banks if the bidding process had moved more forcefully and swiftly, and did the FDIC leave value on the table?
Congressman, it's certainly the case, and it's often a failed bank is often likened to a melting ice cube, in that you want to move quickly to sell it to preserve as much franchise value as possible. I think the situation is simply that we don't have all the facts, or at least as I sit here, I don't have all the facts of what actually occurred over those weekends, but you are not similarly limited. You can obtain from the FDIC the facts, since you are their overseer.
I'm in the car business. Sometimes we say your first deal is the best deal. You want to react and sell it. So with that in mind, Mr. Chairman, I yield back my time. Thank you.
Gentleman yields. The gentleman from California, Mr. Vargas, is now recognized.
First of all, thank you, Mr. Chairman. I appreciate the opportunity to have this hearing. I want to thank the ranking member and, of course, the witnesses here today. I do have to say I want to challenge the premise that somehow President Biden has created all this inflation in the United States. In fact, it's interesting because it's been a worldwide phenomenon. In fact, when we look at our peers across the ocean there, our European peers, they've been running hotter than we are. The UK, their inflation rate's over 10%. The EU is still at 8.8% or so. Some notion that somehow miraculously or infamously the Biden administration has created. No, obviously it was a pandemic, a whole bunch of other problems that we've had globally, and we've had international inflation. It's been everywhere. Anyway, I just had to get that off my chest because every time I hear my colleagues say, I just don't think it's true. Dodd-Frank, what is a good law? Well, was it the right thing to do at the right time? Dodd-Frank. Why don't we start with you, Professor Judge?
I think it seemed like a reasonable move at the time, and I think over time we're learning we probably should have gone farther when we had the opportunity, and that clearly the fact that we are sitting here not that much later and we are facing the magnitude of the bank failures that we are now facing, the losses to the insurance fund that we are now facing. Again, some of that were changes in Dodd-Frank and regulatory changes that went even further than the statutory changes, but I think Dodd-Frank brought about much needed changes, and I think there's always more work to be done. It's the nature of financial regulation.
Thank you. Mr. Gould, I think that you said something like this. We've passed a bunch of laws, but they haven't done much. I think generally something of that sort. Would that include Dodd-Frank?
Sir, I think that expectations of what Dodd-Frank could accomplish and what some of its proponents said it would accomplish were, I think, overstated. As far as I can tell, it did not end the era of boom and bust, at least based on the actions of the regulators just a couple months ago. It would seem that at least under certain circumstances, there are banks that can fail in ways that would have systemic impact. So at least on two major areas, I think it came up short.
Do you think it was a good law in general? Or do you think we shouldn't have had a law?
No, sir, I do not think it was a good law in general.
Okay, thank you. How about you? Apologize, your name is pronounced.
Tahyar, like car tire.
Like Tahyar, yes, ma'am.
Dodd-Frank was, 800 pages?
Yep.
A dozen titles. There's good parts of it, and there are parts of it that, as Jonathan has said, were overstated. I think the paradigm shift in macroprudential regulation was a good one. I think time goes on, and things change, and there's a need for adjustments in some places.
Okay. It would be unfair, Mr. Margaret, if I didn't ask you. Go ahead, sir.
Well, terrific. I think that, thank you. I think that Dodd-Frank succeeded in bringing more capital and liquidity regulation to the industry, which has been well served. But I think that there are parts of it that might have gone a little bit too far and still might even need adjusting. But I think the preponderance of it was supported from capital and liquidity. And I don't think the banks that failed because of capital or liquidity. I think they were overwhelmed by a bank run at a moment in time.
Well, let's get to that. In fact, that was one of the points that I wanted to talk about. I do believe we should have very large banks. I think that's good for the United States and good internationally. I also think that regional banks are very, very important. And of course, the smaller community banks are important. But they always seem that they would be susceptible, both the regional and the community banks, to a run, especially with the ability to the digitalized ability to move money so quickly. Won't they always strategically be vulnerable? Yeah, go ahead.
And just to finish saying, I didn't want to also not say that there were mistakes made about interest rate management to that prior question. I'm not absolving those big banks of that have failed.
Right. Let's get to this one.
Well, I think these companies are trying to build themselves in a more diversified manner. As long as they manage their concentrations and their capital well, I think that, look, there are 4,700 other banks that are doing it successfully right now. I know the 3 failures were spectacular and unfortunate, but there are over 4,700 that are doing a really good job, I believe.
Yeah, thank you. My time's almost expired, but I want to say it just seems that structurally, though, when you can move $42 billion within, within a few days, I mean, they're always going to be structurally, problematic. Thank you.
The gentleman's time has expired. The gentleman from Georgia, the vice chairman of the subcommittee, Mr. Loudermilk, is recognized.
Well, thank you, Mr. Chairman, and thank you for holding hearings on this issue, hearings that are extremely important for things that are going on. So it's great that we're actually able to address these types of issues now. Mr. Gould, in hindsight, the interest rate problem should have been clear, not the least to the Federal Reserve in the case of Silicon Valley. And in Vice Chairman Michael Barr's report, he attributes the lack of concrete supervisory action in the lead up to SVP's failure to a myriad of causes, including supervisory culture under the previous vice chair for supervision. Do you think this is an accurate self-assessment for the Fed, or could this just be simply shifting the blame?
Sir, it's impossible to tell since we, for example, don't have the interview notes on which those kind of allegations are based. So it's for me sitting here, it's impossible to tell. It could certainly be the latter.
Okay. Considering that Federal Reserve supervisors failed to anticipate obvious systemic risks directly related to their own response to rapid inflation, do you believe it's appropriate that they continue pursuing other major supervisory initiatives such as Basel Endgame or Vice Chairman Barr's holistic capital review?
I think they should focus on their supervisory failures and enforcing the regulations that are in the books rather than pursuing additional regulations.
I mean, basically, do the job that you have already appropriately before you start taking on more responsibilities, or you're just going to
That's correct.
fail on those. I agree with you on that. Thank you. One of the recommendations in Mr. Barr's report is that we work to change supervisory behavior and promote faster, more decisive supervisory action. My concern with this is that many of the supervisory recommendations made in relation to SVP were unrelated to the risks that caused their collapse. How would we guarantee that unbridled supervision wouldn't create an environment where supervisors dictate management decisions unrelated to safety and soundness?
I think that's an excellent question and one which I think supervisors grapple with all the time. I think internally you obviously need to have a strong management culture. Unlike regulation, if you're an examiner, your training is on the ground. It's based on judgment acquired over years of experience. All the regulators will say that they apply kind of a risk-based focus to how they think about supervision, but making sure that they are in fact focused on the risks that really matter versus kind of check-the-box exercises on extraneous risks that don't actually matter is really tough. And frankly, there's also always a cost from the bank management perspective, right? If you're giving them, several dozen MRAs, they might be distracted, right, rather than focusing on the MRAs that really matter. So, understanding that I think is really a function of having good leadership and good training.
Well, one thing that's brought up is culture. And one of the issues that I've seen with the culture of regulators is we've seen this transition from the idea that originated in agencies is to work in partnership with industry to come up with regulations that ensure safety, soundness. But in many cases, we see a culture that's adversarial based, that regulators are the adversaries more of, or at least viewed as adversaries by the banks or financial institutions or the businesses. Is that what we're seeing in a lot of these financial regulators? It's an adversarial relationship. In other words, we see that a lot in management supervision, which changes depending on who is in the White House at the time. But when it comes to the regulators on the ground, is that culture an issue? Is that it's more of a gotcha environment instead of let's ensure the soundness and safety of your bank?
I think that's a risk. I mean, the banking agency's prudential regulation is very different from, say, the SEC and the CFTC, which are market regulators and more viewed as enforcement agencies. I think there is a potentially worrisome trend of the banking agencies looking more and more like enforcement agencies over time. I don't know that that serves the larger policy interest of maintaining system-wide safety and soundness if they adopt kind of a more gotcha attitude. Here, though, at least based on what the Fed report says about Silicon Valley Bank, I don't think the issue was a failure to be adversarial. I mean, I think here there was just a lack of follow-through and allowing these issues to linger and get bigger and bigger and not be addressed.
And thank you, because that was part of the point is in some areas it's adversarial and some it's like let's turn our eye to this one. So thank you, Mr. Chair. I yield back.
Gentleman yields. The gentleman from Illinois, Mr. Caston, is now recognized for 5 minutes.
Thank you to the gentleman from Kentucky and all our witnesses. I appreciate you being here on these important issues. I also feel a little bit like that scene in Planes, Trains, and Automobiles where, you're going the wrong way. We don't even know where we're going. Like Neil and Dell, there's a lot of bad stuff in the rearview mirror, but what's coming down the pike is a lot worse right now. Professor Judge, I want to start with you. Secretary Yellen has said that we're going to be unable to pay our bills by June 1st if we don't come to some agreement on the debt ceiling. Do you have any sense of what's going to happen to Treasury yields if we miss a payment?
Clearly, resolving the debt ceiling has to be a top priority. The Biden administration is making it a top priority. They're looking for cooperation. We clearly are going to see adverse consequences on the ability of the U.S. government to fund itself.
I'm asking just numerically because I don't have a Bloomberg terminal in front of me. When I looked 2 weeks ago, there was about a 300 basis point spread between Treasuries coming due before and after the default date. I don't know if you all have
I don't
seen
have a number off the top of my head. There are
Okay.
various estimates that have been out there, none of which look pretty.
Okay. We are talking about rapid interest rate spikes that created mark-to-market problems where it was that volume of an increase over 9 months. Do you have some sense of how many banks are about to get SVB'd from a mark-to-market perspective if all of a sudden there's a roughly 300% increase in interest costs on treasuries?
I expect a number of banks will face challenges if there is a significant a change in the Treasury rate. Again, I think a lot of what banks hold are longer-term instruments that are also keyed off of the risk-free rate. So it is interesting and challenging to know, which is precisely why, going back to where you started, it's never been more important for regulators and for supervisors to be engaging in these forward-looking analyses and trying to understand what are the tail risks.
Second question, we do not require, my colleague was talking about Dodd-Frank, we don't require banks to hold capital for risk-free assets. If treasuries are about to not get risk-free, there's something like an 8% capital charge. How much capital do the nation's banks have to raise if the treasuries are suddenly deemed to be not risk-free assets?
It is a great question. I don't have the number for you off the top of my head.
Does anybody on the panel know that? The numbers I've heard are, the low end of that is $160 billion overnight. I see heads nodding directionally, okay.
It depends upon the risk weight that they would be subject to.
Sure, but if you just look at like 8% of what's out there right now, it's a big number.
Correct. It's a big number. I don't know the number, but it's a big number.
Are you concerned about any banks that might not be able to raise that volume of capital overnight?
I don't see how banks raise capital in the middle of a debt default.
Me neither. What happens to repo markets if the treasuries that are used as the swap on the risk-free premium are no longer risk-free?
This would be a new moment for the markets, and I think there would be a lot of big concerns in a variety of areas to deal with if that happens.
Okay. If we allow the United States economy and the global economy to go into free fall, what happens to long-term U.S. structural deficits as the American people are looking for us to provide social services that the banks can no longer lend money to provide, up or down? Do tax revenues go up? Does government spending go up?
A range of bad things happen, which is why it's all the more important that we're having this hearing and really trying to figure out how do we make sure that banks, but also non-bank financial institutions, are prepared for the range of risks that might hit at any point in time.
Okay. Last question. The Moody's did an analysis of the proposal that my colleagues across the aisle have put forward that in exchange for not committing suicide, we would tank the economy. Moody's analysis is that it would increase the likelihood of recession and result in 780,000 fewer jobs. If we go into recession and spike the unemployment rate, do long-term structural deficits go up or go down? It's not a trick question.
They go up.
Thank you. Like I said, we're going the wrong way, and my colleagues across the aisle would have us believe that the only choice before us is how we would like to die. There are more choices that we have, and I hope we can take these issues seriously and move forward and not kill the entire U.S. economy over some pettiness that somebody doesn't like, a prior tax vote or a prior spending vote. I yield back.
Gentleman yields. Gentleman from Tennessee, Mr. Rose, is recognized.
Thank you, Chairman Barr, and thank you, Ranking Member Foster, for holding the hearing, and thank you to our witnesses for being here. At the start, I want to respond quickly to Mr. Vargas's opening comments about inflation and what I would call the Biden inflation. Years ago, and my professors at Tennessee Tech taught me that inflation is caused when you have too many dollars chasing too few goods and services. So I reflect back a couple of years ago when many of us in this room were sounding the alarm as the Biden administration was kind of doubling down on the COVID relief funds at a point when even people like former Treasury Secretary Larry Summers were saying, this is going to be inflationary. The fact that other countries made the same mistake does not excuse the bad policy choices that the administration put in place of not only putting too many dollars in the economy, but also at the same time restricting production, which dealt with the other side of that equation, so that we ended up with that classic situation that causes inflation, and we got it in just as Treasury Secretary, former Treasury Secretary Summers predicted. And so, unfortunately, we oftentimes have to repeat mistakes of the past. Just wanted to answer that. So the administration's own policies, I think, got us where we are. I think that's important because then the response, the policy response to that from the Fed of dramatically raising interest rates in such a short period of time is part of what has created the stresses that we see that are leading to the bank failures that we've seen in recent weeks. Mr. Michaud, First Citizens Bank stock has nearly doubled since acquiring Silicon Valley Bank, but the FDIC capped its potential gain, our gain, on First Citizens stock at $500 million. In your opinion, do you think the FDIC got a raw deal?
Very hard for me to know all the features that went into the bid that First Citizens made. And I think typically what happens in these whole bank acquisitions is there are a variety of trade-offs in terms of what a bank may pay to acquire a failed bank. So I don't know what trade-off may or may not have been part of that stock appreciation right.
Why not allow the federal government to recoup, or FDIC in this case, to recoup more of its losses and share in those gains?
I think that question would be best for the FDIC to know exactly what the alternatives were at the time, which unfortunately is not something that I know.
Sure. Well, thanks for your insights there. Last year, Senator Elizabeth Warren sent a letter urging Comptroller Sue to block the TD Bank First Horizon deal. And the deal fell apart just last week because they were not given a timetable for regulatory approvals. Now, First Horizon stock is down nearly 40% in the last week. So, Mr. Gould, do you believe the OCC's actions of being influenced by members of the Democratic Party like Senator Warren, specifically as it relates to bank mergers, do you believe that their actions are being influenced?
I would certainly hope not.
Do you think it's appropriate for regulators like Comptroller Sue to give weight to any one member of Congress?
I think it's appropriate for independent regulators to look to the statutory factors that Congress as a whole, as a body, has required them to do so, and that's where their analysis should begin and end.
So, Mr. Gould, we have seen this not only at the OCC, but at the SEC, the FDIC, the FTC, and the CFPB. The list goes on and on. So my question is it important for regulators to be apolitical and to make judgments based on objective criteria? I think you've already answered that, but.
Yes, sir.
Head of Supervision, Fed Supervision, Michael Barr, in his report, touched broadly on the type of regulations that the Fed may consider in their review of the recent bank failures. According to Barr, actions might include increasing capital requirements and adding early triggers to required stress testing when a bank crosses the threshold from one category to the next. The bottom line is that the incremental costs to the banking industry are likely to fall upon that tier of banks below the GSIBs. So, Mr. Gould, my question is, won't these actions just further entrench the GSIBs and make it harder for the regionals to compete?
Sir, I think that the imposition of additional kind of regulations on regional banks will have an impact on the specific markets that they serve, including their availability of credit, the analysis, kind of the comparative analysis as between one type of bank of another, I think is a little hard to tell. And I would hope that the Fed is thinking that through before they put forward any proposal.
Thank you. Mr. Chairman, I yield back.
Time has expired. The gentlewoman from Ohio, Ms. Beatty, is now recognized for 5 minutes.
Thank you, Chairman Barr and Ranking Member Foster, and to all of our witnesses. Thank you for being here today. I'm sorry my colleague, Congressman Vargas, has left for another hearing, but let me say that I want to be on the record of associating myself with his opening statements on inflation. And certainly if we look back in, I think, a report that the President gave just a month or so ago in March, talked about looking over the last 12 months how inflation had actually reduced. And certainly we know gas and food had contributed to it. Gas prices also came down. My colleague mentioned COVID. Certainly there were a lot of dollars and things put in place. Over 1 million people had died because of COVID. Small businesses and the economy was affected. So for those things that he did in that space, I support Mr. Vargas and his opening statements. Now, let me start with Professor Judge. In the resolution of Silicon Valley Bank and Signature Bank, do you think that the federal government took the appropriate steps to intervene and prevent contagion by invoking the systemic risk exception and ensuring all deposits of both banks?
Yes, I defer to the policymakers who had the information, but what we see is policymakers of both parties were unanimous in their perception that this posed a threat to the stability of the financial system, and we have seen that actually no such disruption subsequently materialized, and instead we managed to maintain a relatively resilient banking system despite major losses.
Let me follow up with that. And some of my colleagues on the other side of the aisle are proposing legislation that would place additional requirements on the President, Treasury, and federal banking agencies before they can take action to respond to the bank failure. Would those additional requirements, in your opinion, slow down the ability of those agencies to respond to a bank failure?
Yes, I'm very concerned with the way that they might impede the ability for them to respond appropriately. I think Ms. Tahyar did a great job in her comments earlier comparing the situation to a house on fire, and the first role is for the firefighters to put out the fire. And I think anything that impedes with their ability to make sure that the fire is contained could have real adverse consequences on the health of the economy.
Okay, thank you. Earlier, we've already spent a lot of time talking about the FDIC in the change to the $250,000 limit on deposit insurance. But let me go back to our hearing, I believe it was March 1st, when I asked then Chair Gruenberg about this, and he didn't make a comment on it or declined to make a comment on any particular proposal until the FDIC had reviewed, the whole review was completed. But earlier this month, I think it was in the FDIC report that they released, they outlined 3 options for reforming the deposit insurance. It was unlimited, it could be targeted, or it could be limited coverage, and stated that the FDIC believes that targeted coverage would be the most promising option to improve financial stability. Do any of these options resonate with you? And I'll ask each one of you.
Yes, I thought the report was exceptionally well done, and the notion that we might want more targeted approaches to deposit insurance that allow small business owners to have the additional protection they need and to also maintain that close relationship that they so value with their local community bank makes a lot of sense.
Well, that prompts me to ask other members, do you think Congress should focus on expanding coverage to small business payment accounts?
I 100% agree. I think the targeted approach is the right approach, and I think that is the right cohort to focus on.
Mr. Gould?
I was a congressional staffer here in 2005 when Congress raised the deposit insurance limits from $100,000 to $250,000 for retirement accounts, and I've seen them go up since then. You know, one thing that I think Congress should really look at is historically what the levels have been, what problem you're trying to solve, and make sure that whatever you do in deposit insurance reform, if you do anything, addresses specific problems, and that you also understand that it's not just deposit insurance reform, right? You also have other mechanisms to reduce the risk of runs, including sound and competent supervision.
Thank you for reminding all of us, or many of us, that we raised it recently. And we'll end with you, Ms. Tahyar.
I thought the FDIC report was very well done. I think deposit insurance reform is something Congress has to look at. Nothing to add to my panelists except to say that unlimited insurance, we would be the only country in the world to do that, so I would hesitate.
Thank you.
Gentlelady's time has expired. The gentleman from South Carolina, Mr. Timmons, is recognized.
Thank you, Mr. Chairman. I just want to begin. It's shocking to me that some of my colleagues across the aisle are still living in this, it's a fantasy land. They believe that the $7 trillion of extraordinary spending did not cause the highest inflation environment in my life. I just don't understand. I guess let's just start here. Well, I just want to say this. Pandemic spending needed to happen, but I would say that number was between 1 and 2 trillion, and that was bipartisan. There was 5 trillion on top of that that was largely partisan. So I guess just as a show of hands, well, let's just do yes, no questions each. Ms. Tahyar, do you believe that the $7 trillion of spending done in the last 3.5 years caused inflation? Just yes or no?
Yes.
Mr. Gould?
Yes.
Mr. Michaud?
Yes.
Professor Judge?
I look across the Atlantic, I see UK sitting there, they engage in...
We're going to that next, so you're a no. You're a no. I just want to, you can say no, it's fine.
It does not seem like it was the primary cause.
So I guess this is the next thing. The dollar is still the global reserve currency until this president undoes that, which he just nominated somebody to lead his economic council that believes that we should actively go off the dollar as a reserve currency, which is insane. So do you not see, well, Mr. Gould, I'll start with you. Do you see a relationship between the inflationary environment that we experience in the United States, the reserve currency, and that impacting other countries' inflation and causing hyperinflation in certain countries? Is there a relationship there?
I assume if the value of the dollar is not stable over time, it will lose its appeal as a global reserve currency.
Well, and many believe that the inflation being experienced in other countries can be partially blamed on the United States. I guess let's just go to the issue at hand, SVB. Mr. Michaud, do you think it's best practice to have a chief risk officer for a bank?
Yes, I do.
Okay, so the fact that SVB didn't have a chief risk officer from April of 22 until January of 23, that's a problem.
I don't know the specifics, but something I'd look into given those facts.
What do you think the appropriate ratio of diversity officers to risk officers is? Is that at least 1 to 1? Fair enough? You don't have to answer that. There were 11 of the 12 branches of the Federal Reserve System. They were warning banks about stress testing higher interest rate environment while the San Francisco Fed branch was beating the ESG drum. They were not communicating in the same way that the other 11 were. Ms. Tahyar, is that a problem? Do you think that San Francisco should have been telling the banks to stress test higher interest rate environment? Would that be best practice?
I don't know what was going on at the San Francisco Bank because we don't have the facts. In theory, in a vacuum, all of the reserve banks should have been focusing on interest rate risk.
I've spoken to a number of people that are aware of what they were doing, and they were not encouraging that. Let's go to Congress's role in all this. We delegated our authority to bail out future banks because of TARP. Do you think Congress, if Treasury and the FDIC did not have the authority to invoke the systemic risk exception, do you think Congress would have done it? Mr. Gould, what are your thoughts?
I'm sorry, sir, do you think
Congress would have bailed out SVB and Signature if not for Treasury and the FDIC having the statutory authority to invoke the systemic risk exception?
That's tough to predict. I recall back in 2008, the first time TARP was up for a vote, it did fail. So my guess is it would be
probably not.
It would be tough.
Probably not. And the President and the Treasury Secretary said that this was not a bailout. It did not impact citizens all over the country. But unfortunately, with them ignoring the $250,000 FDIC max and just saying, oh, we're just going to insure everybody, that creates risk, which results in additional premiums, which my constituents are going to pay. So that was a lie. It was just a lie. The president focused on this concern about payroll, which it would have been met, and the president and the Treasury Secretary focused on the fact that it wasn't a bailout and it wouldn't affect anybody. I don't think that the federal government should have bailed out banks that made poor decisions. I think that those banks would have made their customers 90% whole, and the shareholders would have lost everything, and I think that's what needs to happen. When you lose, the free market has corrections, and when Congress gets involved and bails people out, the free market ceases to exist. I do not believe they should have been bailed out, and I am sick and tired of my constituents being stuck with the bill for failed Democrat policies. With that, Mr. Chairman, I yield back.
Gentleman yields, and just a reminder to members not to engage in personalities. With that, the gentlewoman from California, Ms. Waters, is now recognized.
Let me thank our witnesses for being here today and sharing the information that you have. I have been looking at some of the reports that have been coming out, not only from GAO, but from the feds, et cetera. And, you know, based on what I'm seeing, everybody's to blame. You have management at the banks that was not taking care to do what they should be doing, particularly when we look at Silicon Valley Bank. And I don't know who was examining their balance sheets, but they didn't seem to know or understand that many of the securities that they were holding had much less value than when they were acquired, which is one of the problems. I don't know whether because they was the go-to bank for the young, creative business people, the startups, whether they cared whether or not they had insurance. I don't know a lot about some of the issues that we're beginning to hear something about, but evidently there were management problems. They grew too fast to begin with, and perhaps they were too lenient in the way that they made loans, too many uninsured depositors and all of that. But the regulators also had problems. Now, some of those problems were created by 2155. 2155 certainly did, as I can remember, reduce the prudential oversight, particularly as it related to stress testing, for example. Now, there are those who will say that the regulators had options. They could have exercised some of the regulation that was created by 2155. They didn't have to. But the fact of the matter is, what I need is, and I want to direct this question to Ms. Tahyar. I appreciate that you're knowledgeable in your testimony that the White House and Fed Vice Chair Barr raised constructive ideas to strengthen the regulatory framework for regional banks, some of which you agree with and some you may not specifically. Which prudential standards did they highlight that you think should be improved?
I think the long transition period, moving from one category to another, is something that ought to be looked at. I also think that the not passing through OCI in capital, which is something that has been on the books since 2013, should be revisited. And I think Vice Chair Barr's statement that size alone is not what makes an institution risky is in fact a good one.
Thank you. Let me just touch on something that's always controversial as we deal with this oversight. What do you think? Should regulators look to strengthen the stress testing and liquidity requirements among other prudential standards? You know, when we talk about additional capital, everybody goes crazy. What do you think?
I think there are likely some improvements that could be made there, but I would be reluctant to put the same amount of LCR or HQLA requirements on regionals as we have on the GSIBs. I really hope that the regulators will look at that carefully and be fact-based in the policy changes they make.
Well, you know, since you're going there, let me just ask you, as I look at our regionals now, I'm a bit concerned, and I want to make sure that we can do everything to ensure that they are functioning and that they are safe. But why is it that I keep hearing so much protection for regionals when in fact we know that we'd better be taking a close eye on them now?
I think I'm influenced here, Congresswoman, by the fact that I'm from a small town in Michigan. So I know what it's like for small and medium-sized businesses that aren't in major coastal cities. I think our regional banks are the banks that are providing small and medium-sized enterprises with the most credit they can get. When I teach classes, I talk a lot about Joe's Auto Body Shop. You know, he's got 25 auto bodies shops in the Tri-County region. Joe isn't somebody who changes his bank at a click.
Thank you very much. I yield back.
Gentlelady's time has expired. The gentlewoman from California, Ms. Kim, is now recognized.
Thank you, Chairman Barr and Ranking Member Foster, for organizing this timely hearing to discuss the recent bank failures. And I would like to say on the record that I believe the Biden administration's American Rescue Plan's $1.9 trillion injection into that economy helped spur inflation to a peak of 9.1% in 2022, inflation rate that we haven't seen in 40 years. And to tame that inflation, the Fed was forced to act swiftly by raising interest rates at a pace also not seen in decades. Unfortunately, the state of California, where I'm from, we have seen firsthand how partisan economic policies can lead to the failure of two of its biggest banks and wiping nearly $500 billion in assets in just a matter of days along the way. So this is why we're having the hearing, to get to the bottom of those bank failures, and we are trying to strengthen our financial system and protect the backbone of our economy. Those are the small and medium-sized financial institutions, because they are the ones who provide much-needed capital for our small businesses. So let me ask the first question to Mr. Gould. A lot has been discussed regarding FDIC's actions to resolve and sell SVB. So do you think it was a mistake by the California Department of Financial Protection and Innovation to close SVB by midday on March 10th?
Congresswoman, based on what I know from the reports, SVP lost something on the order of over $40 billion in deposits on Thursday, and I think at least based on, again, what I have read in reports, regulators anticipated another $100 billion was going to flow out the next day. Mm-hmm. That is, as I understand it, a deposit run of huge magnitude. So I think the decision to close them was really all that they were left to do. They had no other options. I think there are good questions that could be asked about what led up to those events. But I think at the time, Thursday, Friday, looking at those kinds of deposit outflows, I think that gave them great pause.
Do you think there could have been other ways the California regulator and FDIC could have done differently in the resolution of SVB?
Well, again, it's a little hard for us, I think, to judge, simply because we don't have all the information of what went on, both in the period immediately preceding the closures by California, but also over that weekend, and then in the kind of week or so that elapsed until the FDIC found a buyer, or at least a partial buyer.
Let me follow up, and then I'll ask another question. I know this has already been discussed by previous members who asked the question, and my understanding is that the regulators have the tools like the S-2155 to prevent banks' failures. So can you elaborate on that? Because I wasn't here when that conversation took place. Can you elaborate on your thinking on the argument that S-2155 caused the bank failures?
Sure. So the discretion that S-2155 afforded the Fed in particular, but the regulators in general, gave them the ability to tailor enhanced prudential standards based on the asset size of the banks. They did so over the course of 2018, 19, 20. Had SVB been subject to the enhanced prudential standards that would have existed but for S-2155. With the exception of the LCR, which they would have failed, they would have passed every single other test. And even failing the LCR, it's important to note they were already failing the more important internal liquidity stress testing. And the Fed was not enforcing the existing regulations on the book. And if they had, in order to pass the LCR or to pass their internal liquidity stress testing, they would have had to bulk up on even more high-quality liquid assets, which are themselves, ironically, subject to interest rate risk. So they would have bought more government obligations, thus increasing their exposure to interest rate risk. That is a perverse and ironic impact of regulation in this particular case.
All right, well, I know I only got 9 cents, but I mean 9 cents, 9 seconds. Maybe I'll just address that, ask that, and hopefully you can follow up with that last question that I was going to ask. I will yield back. Thank you.
Gentlelady yields. The gentlewoman from Texas, Mrs. Del Cruz, is now recognized.
Thank you, Chairman Barr, for holding this hearing today as this committee seems to continue to uncover facts around the recent bank failures at Silicon Valley Bank and Signature Bank, and most recently, First Republic Bank. You know, it's critical that this body continues to investigate the circumstances around these bank failures and how really the Biden administration and the financial regulators responded to these events. I am the Congresswoman in South Texas. Most of my community is rural, and a lot of my constituents rely very heavily on smaller institutions, on regional banks. So this is an area of particular focus to me. When the bank failures occurred, I got on the phone and I spoke with those smaller banks, those community banks, or regional banks to ask, how are you all doing? And they said, Congresswoman, we have the adequate capital. We are fine. We will be able to get through this period. But what we are most worried about is that because of the lack of good management on these banks, the failure of the regulators, that we are going to bear the consequences as small community banks and regional banks. And so my question really goes to all of you. Should the Federal Reserve call for stronger regulatory tools, as appears to be implied by the vice chair, and what consequences could this have on our small community, regional financial institutions in districts like mine that, by the way, serve a proportionately large population of Hispanics? In fact, we are one of the largest Hispanic communities in the entire nation. Yes, sir.
Maybe I'll take the first shot at that. My view is that the regulators do have the tools already they need to adequately supervise. And what you speak about, I think, speaks to tailoring, which is the approach that's been done very recently. So I believe that the tools are in place and it's a matter of how it's supervised rather than needing new rules or laws for the Federal Reserve at this moment.
I agree with that, and I think we have a multi-tiered banking system because we are a large and complex country, and we need to continue to have different sizes of banks that are serving different communities. I think that the agencies need to focus on supervision, and they need to clean up house there, more than they need to focus on regulatory change.
Thank you. Yes, Professor?
For me, there's a need to do both. There's clearly a need to ramp up supervision. At the same time, I loved your framing and the attention that you're paying to the community banks and the important roles that they are playing in your district and in local communities across the country. I actually believe that appropriately regulating very large regional banks, banks with over $100 billion in assets that we've learned cannot be resolved in an orderly fashion, would actually help to encourage people to focus on those true community banks and the smaller regional banks that really are focused on serving their community.
Let me ask you a question, ma'am. Where do you live?
I live in New York City, and I grew up in Ann Arbor, and actually the community bank that I work with most is the State Bank of Graymont. It's based in Pontiac, Illinois. We have some farmland exposure in Illinois, and actually they do an amazing job with
I'm going to
agricultural
ask
lending.
you this. You live in New York. How many years have you lived there?
I've lived there about 11 years.
11 years now. So when was the last time you went to rural America and spoke with community and regional banks about what you're proposing?
Last time I went to rural, I spent a lot of time all around the country. I gave the inaugural
In the last
family.
3 months?
I gave the yes.
In
I
the
gave
last 3
the
months,
inaugural
no.
family and small business lecture. Excuse me, at the University of South Carolina because I could not be more dedicated or supportive of small businesses. And I went to South Carolina and I traveled a
yield
lot
my
to
time
talk
back.
to small businesses.
In the last 3 months, speaking after this failure, I think that being among community and regional banks, we will hear the same theme over and over again, which is exactly this, that, and I think it has been repeated several times, the Fed was not enforcing current regulation on the books. And if they did just that, we would not be in the situation. And community and regional banks would not have the fear that they have now for
The
further
gentlelady's
regulation.
time has expired. The gentleman from Tennessee, Mr. Ogles, is recognized.
Thank you, Mr. Chairman, witnesses. I know it's been a long afternoon, but thank you, and thank you for indulging us. Mr. Chairman, I reject the premise that small to mid-sized banks are somehow a problem in our economy. Mr. Michaud, you had said that roughly 4,700 of the small to mid-sized banks are getting it right. So there are 3 banks that failed. They were poorly run, they were poorly managed, and they were poorly supervised. So this is an either-or question for, we can go down the line. We'll start with you, Ms. Tahyar. What's more important for a bank to examine, their liquidity risk or their climate risk?
Sorry, was that liquidity risk?
Liquidity versus climate.
Liquidity.
Liquidity.
Liquidity in both.
Same premise, interest rate risk or climate risk?
Interest rate risk.
Interest rate.
Interest rate.
Interest rate, it doesn't have to be a choice.
Yeah, well, I mean, and obviously we're stating the obvious, right? But when we look at these banks, I mean, we'll look at SVB in particular, who was so focused on climate risk versus their deposit structure. And when I think of actuarial tables, when I think of liquidity risk and I think of interest rate risk, I think of dollars and cents, I think of numbers. But the problem was that these banks were putting polar bears and penguins above their fiscal responsibility. And so any effort to target or impede or to increase the cost structures of our small to mid-sized banks will face a strong headwind from this committee, in particular for me, because I represent rural areas. And it's the small businesses in the communities that are the backbone of my communities, and it's the small to mid-sized banks that are lending to those small businesses. Mr. Chairman, I'll also reject the premise that Biden's policies are not to blame here. Econ 101, when the government puts more money to the economy than the economy can produce on itself, the backside risk of that is always going to be inflation. And so when you force an omnibus bill on the American people, that's an additional $2 trillion that doesn't need to be had at a time when retail prices are going up, when underlying commodities are screaming, stop the madness, and we did nothing other than spend more money. Biden's policies were reckless, they were feckless, and I'm appalled at the idea that he is not to blame. At the same time, he's creating choke points in production, choke points in energy production. So with that, according to the FDIC report, unlimited coverage of deposits, Mr. Gould, would increase the size of the deposit insurance fund to retain basic ratios of insured deposits to the fund itself, and the estimates could be 70% more increase, which that is going to lead to increased assessments on the banks. Is that a good or bad thing?
Well, that in and of itself is a bad thing. Whether or not it's justified by whatever benefit it provides is a different.
So, again, when I think of the increased assessments and the impact that's going to have on my small to mid-sized banks in my district and all the rural districts across the country, Isn't that an argument against an unlimited deposit coverage?
That's certainly an argument, yes.
So when I think about where we are and how we got here, it's easy to armchair quarterback. It's easy to, quite frankly, lay blame. But as we go forward, you know, one of the things that Congress, you know, I've said this before and I'll say it again, you know, Reagan said the scariest phrase in the American language is, "I'm from the government and I'm here to help," is what should we not do as we move forward? Ms. Tahyar?
We should not engage in truthiness. We should look at fact-based evidence and then make policies. We shouldn't just be with our political priors.
That's right.
I think we should examine the efficacy of regulations on the book and see whether or not they're performing as promised, including resolution and recovery planning.
We should make sure the solution is targeted for the need, but also something we haven't spoken about yet, which is there's been a real headwind to healthy bank M&A, and that's been the message that's been sent to the industry. I think ultimately the industry will be healthier, the mid-sized banks will be healthier, and the industry will be able to resolve weaker banks in a manner without the DIF fund if there was a more efficient way to consolidate than there is right now.
I completely agree that we should look at the facts and we should look at the efficacy of the current regulatory scheme. And in light of recent events where you had 3 major bank failures imposing massive losses on the DIF, I think we have to see the current scheme is coming up wanting.
Mr. Chairman, just a few seconds to give you the last word.
Well, I appreciate the gentleman's yielding. I think we're running out of time, and we may do just another quick round. And so I'll take that time, but the gentleman, appreciate him yielding. And with that, without objection, we're going to go to just one additional round with the indulgence of the witnesses and the ranking member. And we've agreed that each one of us will ask one more question. So with that, let me, one more round of questions. So let me just ask, just follow up the question about M&A to Mr. Michaud. On resolutions, if there is a need for additional resolutions, is it important to avoid more industry consolidation for regulators, if there are additional failures, to give regional banks as opposed to GSIBs the opportunity to acquire or merge with failing institutions to preserve that diversity within our financial ecosystem that you talk about?
I very much support the congressional limits where banks with more than 10% of the deposits in the country should not be acquiring other banks. And so I would support seeing, I think the industry needs to build competitors to the 4 banks that have 40% market share. I think the economy would be better off if we had other banks that were able to compete with them more.
And so FDIC reluctance to approve mergers, particularly among regional banks or small banks, could actually be quite anti-competitive.
Well, right now, it's not the FDIC as much as the Fed. The amount of time it takes to complete a merger in the United States has doubled in the last 2 years. Not only that, but there's uncertainty as to the process and the outcome should you look to undertake consolidation. The consolidation that's been happening is regional banks have been trying to combine to create these regional champions to serve their regions and compete with the bigger banks. Also, I believe even as we sit here today, there are banks that are willing to take on banks that may be underperforming, but the banks would be unwilling to take that action because they don't know if the regulatory response would allow them to do it, and they can't afford that risk.
Mr. Gould, your testimony was interesting when you said the proliferation of regulations since the 2008 crisis may have reduced risk management and supervision to mere compliance exercises, damaging both in the process. Can you elaborate?
Yes, sir. I think sometimes regulation, particularly in the absence of competent supervision, provides the illusion that we are addressing risks, and I think that is a problem. And I think we should not be overly reliant on mere regulation. I think supervision is what matters, and I think supervisors have all the tools most fundamentally of which is just examiner judgment to ensure safety and soundness of banks.
Yeah, and over-reliance on regulatory tools such as some stress testing may have blinded supervisors to risks that are hiding in plain sight, like basic interest rate risk. I also thought it was very interesting that you pointed out that the one regulation that Silicon Valley Bank was not subject to because as a result of S2155 and regulatory tailoring was a requirement that, had it been imposed on them, would have actually increased their interest rate sensitivity. The requirement, had the Fed enforced it, on the liquidity coverage ratio and shifting holdings to high-quality liquid assets. Final question to Mrs. Tahyar, thank you. Professor Judge claimed our regulator transparency legislation would impede supervisory responsibilities. I would note that nothing in these bills take away any regulatory, supervisory, or emergency powers. They only are transparency and reporting requirements. Would that in any way impede on the firefighting that you talk about in your analogy?
Chairman, I haven't had a chance to look at the specifics of the legislation. I'll be happy to put something into the record. But in general, we are living in an environment where there is not enough transparency from the banking agencies. And so that makes it more difficult for Congress and others to do their oversight.
Well, let me just stipulate that nothing in this collection of bills takes away any emergency powers of the regulators. And let me just stipulate for the record that the goal of these bills is to give the American people, through their representatives in Congress, greater visibility into decision-making at the time of the house fire, after the house fire. In that scenario, does that in any way impede the ability of regulators to do their job?
No, it doesn't, Chairman.
And with that, I yield 5 minutes to the ranking member.
Thank you. I was wondering if you have, at this point, any general afterthoughts about the systemic risk exception. You know, did it function as designed? Was this an appropriate use of it? Are there any changes that we might contemplate on that? You know, particularly, well, obviously it's a big issue with a lot of the members here, how the special assessment is going to land. If you have any advice on, if you were to craft the special assessment, what would it look like? And if I'm remembering correctly, only the first two banks had the systemic risk, the third failure did not, and so most of the hit to the diff actually will come through the special assessment. And so, do you have anyone want to venture any thoughts on how
I'll start with the systemic exception. I think it was a good decision to do that, because if I think it hadn't happened, I think more banks would have failed. And it was due to the sudden nature of the bank runs, and I think in that moment it was important to do. The other thing is closing a bank in the middle of the day is highly unusual. It makes things disorderly. I know that Jonathan earlier spoke about it would be interesting just to learn what we can do better in the future as to what happened in those hours. I think the impact after that was dramatic. So I think it's best if this resolution happens when markets are not open.
Any other thoughts, Ms. Tahyar?
The systemic risk exception should be rare, but it's there for a reason. And this time it was used wisely. I think the three keys do provide some political checks and balances. But again, I think we still need to have after-action reports with transparency and accountability around, what happened when and how.
Are there any aspects of that give you heartburn? For example, there's a lot of freedom in the special assessment, and there's a lot of danger that that'll be very politicized.
Thank you for
unavoidable.
Yes, thank you, Ranking Member. The special assessment is, we already have the White House fact sheet, which is saying that it shouldn't fall on community banks. I think that is appropriate given the need to protect community banks. But I think other than that, I think there needs to be, a fairness about how that special assessment is allocated among the bigger banks and among the regional banks.
And what are the sort of factors that you know, if you were to write it, would be considered, you know, the fraction of uninsured deposits or various other, you know, so, you know, and in terms of fairness, what you'd want is banks which had a similar business profile as Silicon Valley Bank or Signature and so on should be preferentially hit with the assessment. Are there reasonable ways to do that?
You're thinking if you have a higher proportion of uninsured deposits, you should
For
have
example,
insurance.
whatever the risk factors
Whatever the
were,
risk
you want
is.
to punish banks that had similar risk factors, you know, in some sense.
That particular point makes sense to me. I have to say that I feel like there's still a lot to learn on how that special assessment should happen. So I'd prefer to wait and see what the FDIC proposes and then react to that.
And Ranking Member, I would just, what we talked about earlier, I think there's a lot of value in being too big to fail, that these banks are just, because of their size, are receiving more deposits as we speak. And so I believe that those banks should bear a higher proportion of this assessment. Not all, but should bear a higher proportion than they do today.
Mm-hmm. And any thoughts on the extraordinary support that was provided to banks holding treasuries, that, you know, using them as collateral, I guess, for loans at par, which seemed like maybe a significant intervention?
My view on that is that they are the lender of last resort, and the market needed it at that moment, and it brought stability. We can figure out all these things if the market's stable and orderly. It wasn't, and I think that facility helped bring stability so we could have this conversation.
I would just note that Dodd-Frank did make very significant changes to the systemic risk exception and to 13.3. I think those were healthy and important changes to have made, but I think this was an episode of actually both instruments being used very prudently by regulators to help maintain a stable and healthy financial system in the face of significant bank failures.
Okay, well, any further thoughts you have? You know, we're going to have to be pondering this for a while, and I really appreciate your thoughtful comments. Thank you. Yield back.
The gentleman yields, and I'd like to thank our witnesses for your testimony today. Very illuminating and timely topic. And without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witness for their response. I ask our witnesses to please respond as promptly as you are able. This hearing is now adjourned.